On January 27, 2026, the National Association of Insurance Commissioners released fourth-quarter data that barely made a ripple in mainstream coverage. Insurer insolvencies were up 43% year-over-year compared to Q4 of 2024. That same week, 3 regional property and casualty insurers operating in Florida and California entered receivership. Over 870,000 policyholders were affected. Let me be very clear about something. This is not what if. This is not it could happen. This is the early phase of what happens when climate volatility outpaces actuarial models. Bond portfolios implode under rate shock. Regulators delay repricing, and capital cushions quietly evaporate. Your insurance policy, the contract you've been paying into for years, is not a vault. It is a conditional promise backed by statutory reserves that are shrinking, investment portfolios that are underwater, and a state guarantee system that was never designed for synchronized failures. The question is not whether stress exists. The question is how much time remains before failures cluster. And once clustering begins, the mechanics accelerate. Today, I'm going to walk you through the structural defect inside modern insurance balance sheets, why insolvencies are rising now, the collapse sequence that historically follows, why the guarantee fund system cannot absorb multi-state failure waves, and the exact steps you should take in the next 30 days. Not fear, framework. Because once you understand the machinery, you stop reacting emotionally, and you start acting rationally. Everything begins with a metric most policyholders have never heard of. The combined ratio. It's simple. Claims paid plus operating expenses divided premiums collected. If the number is below 100%, underwriting is profitable. If it's above 100%, the insurer is losing money on every policy written. For most of the last decade, major property and casualty insurers have operated with combined ratios above 100%. That means underwriting losses were normal. So how did they survive? Investment income. Insurance companies are not just risk pools. They are massive bond funds with insurance operations attached. They collect your premiums today. They invest that money, primarily in bonds. They earn yield while waiting to pay future claims. For decades, that model worked until rates went to zero. From 2009 through 2021, interest rates were artificially suppressed. Safe bonds yielded almost nothing. To maintain returns, insurers reached for yield. They bought longer duration bonds, 10-year, 20-year, 30-year treasuries, long-dated corporates, yield 2% to 4%. Then, in 2022 and 2023, the Federal Reserve raised rates at the fastest pace in modern history. Bond prices collapsed. A 2% bond issued in 2020 is worth dramatically less when new bonds pay 5%. Insurers are now sitting on hundreds of billions in unrealized losses. They don't show up on statutory books, yet, but they exist. And here's the problem. When claims spike, bonds must be sold. When bonds are sold, losses become realized. When losses become realized, capital erodes. When capital falls below regulatory thresholds, receivership begins. This is the same mechanism that collapsed Silicon Valley Bank. It is not hypothetical. It is arithmetic. While investment portfolios were weakening, claims were accelerating. Hurricane losses in 2024 exceeded $120 billion. California wildfire losses hit $38 billion. Severe convective storms, hail, flooding, wind are increasing in both frequency and severity. Actuarial models rely on historical averages. Climate volatility is breaking historical averages. Insurers priced policies based on backward-looking data. Forward-looking volatility is exceeding assumptions by 30 to 50% in many regions. Premiums cannot adjust fast enough because regulators cap increases. And when pricing lags risk, underwriting losses widen. In Q3 of 2025, The industry combined ratio hit 108.3%. For every $1 collected, $1.08 was paid out. That is a slow bleed, but slow bleeds become arterial under stress. Insurance works on pooled risk. Many policyholders, few simultaneous claims. But climate events are becoming correlated. Hurricanes hit entire coastlines. Wildfires engulf entire counties. Hailstorms total tens of thousands of vehicles in a single event. When losses are correlated, they are not staggered. They are simultaneous. Simultaneous claims create liquidity strain. Liquidity strain forces asset liquidation. Asset liquidation crystallizes losses. Losses destroy capital. Capital depletion triggers regulatory intervention. Receivership begins. This is the sequence. We are mid-sequence. When insurers fail, state guarantee funds step in. But here's what most people don't understand. Guarantee funds are not giant pre-funded insurance pools. They are assessment-based systems. When one insurer fails, surviving insurers are assessed to cover the gap. Those costs are passed to policyholders through surcharges. So failure does not disappear. It redistributes. And redistribution under stress creates a feedback loop. More failures, more assessments, higher costs, weaker margins, more failures. This is how crises compound. In Florida, Citizens Property Insurance now covers over 1.3 million policies. Exposure exceeds $600 billion. In California, the FAIR plan has grown 150% since 2020. These are insurers of last resort. They are not capitalized like private carriers. If they experience catastrophic loss, every policyholder in the state receives an assessment. This is not alarmism. It is how the statutes are written. Mid-1980s, asbestos and environmental liability claims triggered over 60 insolvencies. Premium spikes hit 300% to 500%. Coverage gaps emerged overnight. Savings and loan crisis. Asset liability mismatch destroyed over 1,000 institutions. Long-duration assets. Rising cost structures. Insurance today mirrors that imbalance. The difference? There is no federal FDIC-style backstop for insurance. It is state-fragmented. Capacity is limited. Reinsurance is insurance for insurers. Primary carriers offload catastrophe risk to reinsurers. In January 2026, reinsurance rates jumped 35% on average, 60% plus in Florida and California. Some reinsurers exited markets entirely. Primary insurers now face a choice: pay dramatically higher costs and destroy margins, or retain more risk and increase insolvency probability. Neither path is sustainable. Reduced reinsurance means new policy restrictions, higher deductibles, coverage withdrawals, market contraction. Statutory accounting allows insurers to carry bonds at amortized cost. Unrealized losses remain hidden until bonds are sold. When claims demand liquidity, bonds are sold. Capital ratios fall. Receivership begins. This is precisely how liquidity crises evolve. Gradually, then suddenly. Insurance stress is not isolated. Commercial real estate is under pressure. Regional banks carry unrealized bond losses. Corporate bankruptcies are rising. Credit spreads are widening. Insurers are major holders of corporate bonds, municipal bonds, commercial real estate debt. When those markets strain, insurer balance sheets strain. 2008 proved this. AIG required $182 billion in support. The trigger was investment exposure. Interconnectedness amplifies weakness. Where we are in the cycle. We are not in the panic phase. We are in the acceleration phase. Insolvencies rising 43%. Regional receiverships increasing. Reinsurance tightening. Combined ratios above 100%. Capital erosion ongoing. Clustering has not yet occurred. But the velocity is increasing. And crises compound non-linearly. The 30-day action framework. Understanding without action is intellectual entertainment. Here's the practical checklist. Check AM Best, Moody's, or S&P. If your carrier is rated below A-, reconsider. Counterparty risk matters, especially now. Most states cap payouts between $300,000 and $500,000. If your insured value exceeds that, the excess is unsecured in insolvency. That means years of uncertainty. Adjust coverage structures accordingly. If a claim is tied up for 18 to 24 months, can you rebuild? Hold more liquidity, short-duration treasuries, physical cash, assets outside single counterparty dependence. Liquidity is resilience. Expect 50% to 100% increases over the next 3 years in high-risk zones. That's not fear. That's actuarial math catching up. Plan now. Multiple carriers, multiple jurisdictions, legal entity structuring for asset separation if appropriate. Risk concentration kills flexibility. Captive insurance, risk retention groups, parametric coverage. These tools are complex, but they remove blind reliance on traditional carriers. High net worth individuals and business owners should at least explore them. Insurance feels permanent. It feels stable. Because for decades, it was. But systems change quietly. Carriers continue issuing renewals until the day before receivership. Regulators publish solvency reports that lag by months. Media treats failures as isolated. Then clustering begins, and optionality vanishes. Crises do not announce themselves in advance. They accumulate, then they cascade.